Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of The Options Playbook, and I'm going to be your host here for about the next 25 minutes on Options Guy TV. Well, I hope you enjoyed the day off. I did. I got some, lawn work done. I have to admit that I did a few things that I needed to do and knocked off the honey-do list. But our SPX trade is very interesting, so I want to start there. We put together kind of a last second at the end of Options Guy TV on Wednesday. We had the Fed meeting coming up, and it was highly anticipated that they were going to say nothing, and they did do nothing. The market kind of took it bearish, and the market did go down a little bit. I'm very sad because I actually thought we were going to get a little bit of a move to the upside and that we might actually knock our butterfly out of the park. That didn't happen. The market had to go down just because I really wanted it to just open up. So with that happens, we're still profitable on the trade. So, and that's what I wanted to bring up. And here's one of the things is heading into that Fed meeting, we had elevated implied volatility. And when volatility is high, butterflies are cheap. We had all the Thursday holiday. So going in, that kind of gets priced into the option contracts. Well, it does get priced for sure, but the fact that the holiday was in there kind of made it just a different trade because it doesn't happen that often that we have a Thursday holiday. So let's run straight to the Tradier Pro software right away. And you do have questions. Now, recently, I haven't received a few questions, or I haven't had a lot of questions inside the chat box. So feel free to answer. I want to make this as live and interactive as possible. So if you do have questions about the current trade that we have on or a previous trade we've done, please do put them in the chat box and we'll try to address them during the show. So SPX right now is down 20 or 1/3% at 59.60. Kind of a muted move as we head into the weekend. So that 6,000 level, we dance above it, then we dance below it. Once again, we have very volatile markets that aren't going anywhere, right? Every time we take one step forward, we take two steps back, and then sometimes we take two steps forward, and then we take one step back. So it's selling premium, I think, is interesting to do, and that's really what a butterfly is. Even though you pay a net debit for it, you are selling two at-the-money option contracts, as I'm highlighting here on my screen, and that is the staple to the butterfly. You need that time premium to go away in those option contracts. Now, it can go away if it has intrinsic value or not, but ideally you want it to sit right at the 60-10 level, and you want time decay to happen or erode. Anytime you're within these strikes, that's what you would like to do. Now, this is no baloney, and I would trade and get out of it right now. But when we started the show, you saw the number in there. It was 143. Now, time decay is huge in the SPX right now. So the market is down, and it has actually drifted a little bit more south too. We put this on for $1. You can get out for $1.20. Why are we making money when the market went the wrong direction? It's because we had pumped up volatility, and volatility helped us in this situation. We put it on with volatilities are high, volatilities are coming off. Now it's viable to that the market can still get up and reach within our strikes, and we're getting paid for that. Now, it was $1.40 10 minutes ago. So, why does that seem to happen every time we get on Options Guy TV? The market just moves precipitously and usually in the other direction as soon as we start talking about a trade. But I would close this one right away. There's no reason to mess with it. There's no adjustment that you make on it. Would have closed it probably on the open this morning. We were a little bit more flat on the open. Now we're down 1/3% and the trade was actually even more profitable in the morning. So I really was thinking the market would open up and there was a chance that we might actually land right in the sweet spot of our strikes. But SPX is a very different beast. It holds time premium. Just the fact that it's a 5,000, well, let's call it a 6,000 point index, just round up a little bit. And because of that, it takes a while for time to premium to go away. And so if you are not correct on a butterfly, right, you need that time premium to hang around. If you are correct on a butterfly, you need it to go away. So SPX really loses time value precipitously, basically from this moment that we start the show all the way to the close. The last half of the day on the expiration Friday is always a crazy amount of time decay as far as the SPX is concerned. And they trade dailies, right? So we can do this on a daily basis if we wanted to. We just kind of took it. I don't know if we took advantage of, we had high implied volatility because of the Fed. I guess I'd say that we took advantage of the situation. We set up a solid trade, and we were incorrect in our forecast. We're going to make some money on it. You can actually sell it for $1.28 right now. Now, you could let it ride if you just did one contract and you paid $1 for it and $100 for a 1x2x1 butterfly. Look at that, market already moved $5, right? It just happened. We were down 20, now it's up 5. And it's reflected. We still have some delta. We still have some positive delta on this trade. All right, I find that this is a very interesting trade. That when we kicked off the show, it was trading for 140. You were up almost, you were up 40% on your trade. Paid $1 for it, and you could have sold it for 140. All right, now, so the bad news. If we go and we look at Adobe, we had a skip strike butterfly on Adobe, but we also did a short spread. So the Adobe skip strike butterfly that we put together, I still like this trade, and I would continue to do this trade almost on a weekly basis. Adobe doesn't get the respect it deserves. Solid. It's almost like if they were a startup and they weren't called Adobe, I think the stock would do well for them. I just think people think of Adobe and they think of old school PDFs, which everybody still uses, and they're making strides in the AI field. But the marketplace, I guess, this is what I have heard from the analysts and from what I've read is the marketplace just decided that they're not doing enough in AI, even though they upped their guidance, even though they had solid earnings. They feel like they're falling behind on AI. I don't get it. All right. So I like the skip strike butterfly, and I'd like to continue to do them. I did a short put spread, and we're hurting. Market was at 390. We sold the 390, bought the 380. And we did a 7-11 trade. So July 11th is when that expires. There's not much we can do to adjust the trade. We talked a little bit about rolling it into a butterfly. But I don't know if I don't like that trade. I don't like the way that it all planned out when we were looking at it. So at this instance, I can let this one ride a little bit at this point in time, but I'm going to keep it on a short leash. I think we let it ride over the weekend. We see where it's at, and then we maybe close it on Monday or Tuesday. But that's just the way that we're going to look at that short put spread. I would continue to do these skip strike butterflies in Adobe. I do like them. I like that you can get a decent net credit for them. As a matter of fact, you want to set one up? I just don't want to. We have a position on, so it's hard to say that. Ideally, I wouldn't do this in my own portfolio. Let's put it that way. I wouldn't have this one position on overhanging and then try to do something completely different on the other side of it. I'm not adjusting the trade. This would be a new trade. But I realize that a lot of people don't put the trades on. So if you were looking at Adobe and I was looking at it right now, I would look to do a skip strike butterfly on a new position. So let's do it. And I just think this is a good trade until the market realizes that they're wrong and that Adobe should go up. But I say that wink, wink. 400 strike. It's right at that nice level too. 4,205. So that's 260. It'll be close. We need to get about. We're gonna go 5 points wide. We'd want to get 50 cents. 2, 4. And that's 3. What's the 24 delta right here? Okay, so doing just quick math in my head, I think this might work. I want to try to get at least 50 cents. We're going to go 5 points wide on the risk. So this is our first leg of our skip strike. Here is our second leg, 5 points wide. Means the maximum we could trade for is 5 points. We're going to skip to 405. and buy the 410. I don't like the price of the 410. And implied vol staying pretty flat across that. 26 cents. Oh, there we go. 50 cents. Keep there. Stay. All right. 50 cents. I get that done for 50 cents. I'm okay with it. I like that trade. All right. We're going to go out 21 days on this, out to the July 11th trade. And it's tight. Now, this is one of these things, and we talked about this on Adobe, actually, when we looked at the short put spread, is that the markets can get a little bit wide, and it has a little bit more to do with the fact that it's a $377 stock. Volumes are okay, but when you get a little bit pricier, you see it in the SPX too. Bid-ask spreads will artificially widen. If I could get this done, I want to get this done somewhere close to the 50 cents. And my rule is I got 5 points of risk, which is from 405 to 410. I'd like to bring in about 10% of that. So 5 points of risk, if I can bring in 50 cents, I'm okay with this trade because we have the hedge on it. That would imply that if you were doing the short call spread, you'd probably end up bringing in close to $1. And that's about where you would be at. 89 and 54, so that's 61 cents on that. And let's see where the actual butterfly is at. Let's close this and add, this would be a standard butterfly. So that's 23 cents. So you're paying 25 cents of your net credit to buy that butterfly. And to do that, we just skip that strike and we buy this one. Now it's only 16 cents. All right, let's send this to the what if calculator. This is going to be a paper trade. I'm going to watch both of these positions going into the weekend. Here we go. Market's right here. 377 is where the market is at. We're a little bit beyond a one standard deviation. Well, we're about where a one standard deviation move is with our short strike. To start with, this is what your profit and loss graph looks like. Just like if you did a short spread, it hurts you if it comes up and hits your short strike right away. But as time decays, this profit and loss graph will eventually morph into what it looks like at expiration. So we really want a couple of weeks to go by before it would start drifting that way. But ultimately, when we're doing these skip strike butterflies, and I emphasize this all the time, is we're doing it as an alternative to a short spread, not an alternative to the butterfly. Our goal is mainly to make the net credit that's received from executing that butterfly. So if we can get this done for 50 cents, we make 10% on this trade. We have our hedge put into it, means that we don't have to adjust it right away. If we put the trade on and the market went against me, I would just close it. So if I did this today and by the close tonight, it was at the end of the trading day, the stock hit 400, I would just close it and get out. And that's the exact same type of thing that I would do on my short spread too. I would just close it and get out if I hit my maximum risk that I was willing to take. Now, the biggest upside of this is that as expiration approaches, this line drifts towards the middle, and there's less adjusting that you have to do, but you pay for that reward. You receive about half, has been my experience, of the net credit that you would receive if you just did the short call spread. And I think it's a valid trade-off. I like looking at the skip strike butterflies, but you need to have a little bit higher pricing. You need to have you need some volatility and some predictability. It's hard to do a skip strike butterfly in, the XLF, some financial ETF, or anything where the volatility is muted, like an index or an ETF, something that tracks a specific sector. All right, that's going to be the paper trade for this week. Now we have USO on, and we did say that we got a position that is up, and the weekend is scary. I don't mind staying bullish on USO. I don't mind it at all. As a matter of fact, Monday, I will probably put another trade on in my own account in USO. I've already taken this trade off that we did where we sold the put spread and bought the long call only because the profit was made. If you look at, let's go to the what if calculator. Here's the entire position, right? We sold a put spread to pay for a call. Well, I got to send it to the down below. Here we go. When I have my, yeah, just let me click these buttons and send a ticket. There we go. So when we put this all together, we sold the short put spread, brought in about $1.60, took that $1.60 and bought the 90 call and paid about $1.50 for it. So the 90 call is $3. So at a minimum, I would probably sell the 90 call, right? Just because you've already doubled on it. You got $1.40, you paid $1.45 for it. You can close it out for $3. That's 100% gain on that call. Now on the other side of the coin, the short put spread, we are a little bit of a ways away. So if you do get some news headlines over the weekend, you got a little bit of room to run, but you've done well on that trade too. It's stickiness with the premium because of obviously the uncertainty in the marketplace. So vols are elevated. It's trading for 65 cents. We put it on for, I think, $1.60. So we're up about $1 on the trade. Makes total sense just to get out of the trade. Not that your forecast might still be that you're long oil, but you made the profit. You already did fine on the short put spread. You did fine on the long call spread. Rules say just get out. Now, on Monday, if you just because the weekend stuff is going to happen over the weekend, there's no doubt. There's just too many news headlines, too many people speaking, too many things happening. So do you want that risk or not? If you want to speculate on that type of risk over the weekend, yeah, there's nothing wrong with doing that speculation. We just met our profit goal on this scenario. All right. So what's a trade that you could do around the if you just wanted to speculate on the move over the week? Here's an interesting way to trade it. I like this trade, but this trade was put together because of the chart. It wasn't put together because of the political unrest. I mean, that obviously helped the situation and made it profitable a lot quicker than first anticipated. Went out quite a few days in time, right? We went out to 7-11, which still has about 21 days remaining until that expiration date. All right. If you just wanted to trade on USO, here's what I would do. I would skew a little bit to the upside by a little bit in the money trade. Let's look at going out. Well, July 2nd is an interesting day, right before the holiday. Okay. And with 12 days, if you just think that there could be some more political unrest over there, and that might increase oil prices again, if you look at just selling a short put spread, there's a very interesting skew. The risk reward ratio is very solid on these short-term option contracts. And, it's a commodity. Now, USO actually tracks the futures contracts. It used to, way back in the day, actually just be stocks that were energy companies, and they switched it and they made it so that it tracks the futures, and it does an okay job of it. It's it's okay with what it does. The markets are fairly good, and usually we've got a little bit wide on our bid-ask spread when volatility skyrocketed. But you want to just do a short-term trade, hoping that oil stays the same. You get a solid risk reward from just selling a put spread. So let's look at selling the 80 strike. And we're going to go down and buy the 86 strike. Okay, so that's 4 points wide. Gotta get rid of this. Sorry about that. Sell the 80, buy the 76. So you're looking at $1.44 on a $12 trade. So you are risking 144 minus 4, so $2.56. That is your risk on the trade. And the reward is 144. So 2. So 0.56 reward to risk ratio, which always gets quoted incorrectly as a risk reward ratio, on a 12-day spread that is 2.5 points out of the money. That's a real solid risk reward ratio, and you wouldn't get that on a stock on a 12-day trade. So the math is positive, and we know. I noticed this on the last show. As a matter of fact, this is what has drawn me to this trade. Is, you look at the implied volatility here. The implied volatility on the 80 strike is a 61, and on the 70 strike is 55, and that's normally not the case. So it is skewing to the upside. The vol skew or smile or tilt or however you want to say it. Notice as you go further out of the money, these option contracts are trading at a lot higher implied volatility. And because of that, you're getting a real solid reward risk ratio for selling a put spread, just short term. So if you think we can hold, if oil isn't going to collapse over the weekend, this is a very interesting way to play the trade. All right. Well, I look at the clock. That's about it. I said 25 minutes. We're at 22. No comments that I see right now in the chat box. And so that's it for this edition of Options Guy TV. We'll be back on Monday at 11 a.m. Eastern Time. Best place to watch Options Guy TV is inside the Tradier Hub, hub.tradier.com. You can ask questions from inside the hub if you build a username, and everything is free, and then you'll have access to all the great speakers that Tradier sponsors inside the hub. So thanks for stopping in. We'll see you Monday at 11 a.m. Eastern Time for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.